one of the most important issues, which is the debt of Elis. And they have ratings, and Standard & Poor's is one of the rating agencies. And they used to have a rating of BB plus before the crisis. And then during the crisis, they lowered the rating to BB with a negative outlook, and then they took the negative outlook back, and now they are just BB. So they have now degraded to BB, which is actually where most of the non-investment grade bonds are in the European Union. So about 70% of the bonds in Europe that are non-investment grade are BB. So they are in good fellowship there. However, it is still high yield, and it's what you call junk bonds. So Elis is non-investment grade, which is important because right now the central banks are just buying investment grade debt, and so you have just private investors that invest into non-investment grade securities, and it's a very volatile market. So when you look at the European high yield bonds, and BB is 70% of this index, then you see that there is quite some volatility. And if you have a debt crisis, then you see it as a huge impact. So liquidity in the market can be a real issue. And when you have no liquidity, then of course you have very, very high yields and very, very high prices for financing. And so this was the finance crisis in 2008 and 2009. And actually, I'm not so sure about the next 1 or 2 or 3 years, how it will develop, because there is some speculation that after the government guarantees run out, you might have about 7 to 12% defaults, and there is quite some risk that the yields for junk bonds increase in future. And this is, of course, an issue with the refinancing of Elis, because when you look at the maturities of the debt, then this year they have to refinance about 300 million in bonds, which is no issue because they have liquidity of beyond 1 billion euros, so they wouldn't even have to refinance it. So this is basically not a big deal for them when it comes to liquidity, but still it will be interesting to see the interest rates. Sorry. That they will be able to get this year. And next year they have to refinance everything that has a maturity for 2023, maybe even this year. So they have to extend their revolving credit facility, and they have a maturity of about 1 billion in debt next year. So this is the year after. So this year or next year they have to refinance it, and this will be quite some exercise. And then every year you have about 500 million in debt that they have to refinance. So this is quite a lot of money, and above that you have also lease liabilities. So they've started to have also operating leases, and they have a current waiver of the covenants for the debt, and this waiver expires this year in December. So actually, I think this is some risk, and this might also, of course, be the reason for the credit rating as a junk bond, because altogether they have they have almost 3 billion euros. They have actually to refinance in the next 2 years as much as the whole current revenue. So the whole current revenue they have to refinance, and if they get interest rates that are a few percent higher, then basically every percent of higher interest is 1% less profit margin. So this is quite some risk. And they have also some risk of exchange rates, because they finance everything in euro, and about 7% of revenue are in Latin America. I have not been able to look up the number of the actually invested money in Latin America, so it's probably I would need to look at all the annual reports of the last years and see what they paid for the M&A. Their investment in Latin America has had to be depreciated, and this had a net negative effect of 173 million euros last year, which is actually 6.1% of sales. So of course it will probably not happen every year, but you never know.